Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane,
Back to the channel. Quick update on the market and some of the latest economic news today. As you probably know, the Federal Reserve made a rate hike decision today, announcing a 25 basis point increase in the target funds rate, bringing it up to 4.5% to 4.75%. This move was a bit of a slowdown from the 50 and 75 basis point hikes we've seen recently, which were aimed at fighting inflation. However, with inflationary trends falling and the GDP growth outlook slowing down, the Fed decided to pause its hikes for now to see how the recent rate hikes are affecting the economy. In the stock market, growth stocks outperformed value stocks as yields fell. Fixed income investors took the Fed's commentary positively, which led to a drop in the 10-year Treasury yield to around 3.4%. On the other hand, the energy market didn't have as much success. Natural gas prices have fallen significantly from their high of over $10 last year and are now trading around $2.60. Oil prices also sank more than 2% after OPEC Plus decided to stick to their current oil output levels and after reports showed that U.S. crude oil inventories have risen sharply. Unfortunately, payroll growth in January was soft according to ADP, which could be a sign that corporations are slowing down on hiring. The service sector was the driving force behind the hiring, while construction and transportation lagged behind. The construction sector has come under pressure with rising mortgage rates and falling demand, and the recent cold snaps could have also impacted near-term hiring demand. The labor market has been a key area of strength in recent months and is closely watched by the Fed to judge the impact of rate hikes. The soft payroll growth in January, as reported by ADP, is a sign that hiring from corporations could be slowing. Despite this, we expect the unemployment rate to rise slightly this year as economic growth softens, but historically low unemployment levels and a large number of open positions should cap how far the unemployment rate can rise. That's a quick overview of today's market and economic news. Now let's take a look at Amazon's earnings preview and how are we going to play this. Amazon is set to release its fourth quarter earnings report tomorrow after the market close, and we're all eagerly waiting to see how the tech giant performed during the holiday quarter. Amazon's stock took a hit last year, slipping over 30% due to a number of headwinds such as inflation, rising energy costs, supply chain woes and recessionary fears. Now, what can we expect from this earnings report? Well, Amazon is expected to report revenue of $145 billion, which is up from $137.4 billion from the same period last year, and earnings per share of 17 cents for the December quarter. However, after the pandemic-driven growth, Amazon's sales have slowed down and expenses have risen, so the company has been taking measures to tighten its belt. This includes pausing hiring in certain businesses and shutting down some products and services. In fact, Amazon recently laid off 18,000 employees, which is the largest layoff in its history and the largest by any tech company in the past year. The company has also been careful with its hiring and has trimmed back on some products, services and entire businesses to keep costs under control. Despite this, analysts at Wedbush believe that this cost discipline could drive profit growth, and they have maintained their outperform rating for Amazon's stock, estimating shares to rise by 40% in the next 12 months. One thing to keep an eye on is the performance of Amazon's cloud business, which is a key driver of its profit. Last week Microsoft said it saw moderated consumption growth with its cloud platform in the most recent quarter, but it still reported cloud revenue increase that was better than feared. I would expect this to be no different for Amazon despite companies cutting costs. I will be adding more shares tomorrow as well, opening call positions at the money. In conclusion, tomorrow's earnings report from Amazon will give us a good idea of how the company is performing and what measures it's taking to stay ahead in these challenging times. Next up, Qualcomm. This networking chip and equipment maker has seen its share price drop by more than 24% over the past 12 months. But don't worry, since the beginning of 2023, shares have been up by 21.2%. Now, with recent weak results reported by Micron and Intel, investors are naturally starting to ask questions about Qualcomm. Unfortunately, the smartphone sales forecast for 2023 isn't looking too good either, with sales expected to drop nearly 10%. And to make matters worse, there's a possibility that Apple could drop Qualcomm as a supplier in a couple of years. But despite all this, out of 32 analysts covering Qualcomm, 24 have rated the stock as a buy or strong buy, and 7 more have rated it as a hold. With a share price of around $133 and a median price target of $150, there's a potential upside of 12.8%. And if you're feeling optimistic, the high target of $250 gives an upside potential of almost 88%. In terms of earnings, the first quarter of 2023 is expected to bring in revenue of $11 billion, which is down by 3.4% from the previous year. The adjusted EPS is forecast at $2.35, which is 30% lower year over year. For the full 2023 fiscal year, analysts are expecting the company to post EPS of $10.24, down 18.3%, on sales of $40.01 billion, down 9.4%. Qualcomm's stock is currently trading at 13.0 times expected 2023 EPS, 10.8 times estimated 2024 earnings of $12.29, and 11.7 times estimated 2025 earnings of $11.37 per share. The stock's 52-week range is $101.93 to $192.10, and Qualcomm pays an annual dividend of $3, yielding 2.25%. Over the past 12 months, the total shareholder return has been negative 22.57%. I won't be playing QCOM for earnings, but if you were, it might be a good idea to open straddle option position. That's all for now, folks, but as always, do your own research and make informed decisions when it comes to your investments. Thanks for watching. Subscribe, comment, and like the video, and I'll catch you in the next video.